Hey guys, today I'm going to be talking about the PE ratio as well as the EPS, earnings per share. The PE ratio is made up of the EPS, so I'll start with the EPS first. Earnings per share looks at the total company's earnings per share that is outstanding, that is free float, that is available to the public. So for example, a company might be, obviously 100% of the company might be split into different types of ownership, and 10% of that whole ownership might be actually free float, so available to the public. So you'll be dividing by those shares. And the earnings you're looking at is obviously the net income of a company. So essentially you get the whole earnings of a company, the net income, and divided by all the free float shares. But you have to watch out, because when you're analyzing each quarter of a company, you can't have a quarterly EPS. You always have to have an annualized EPS. So for example, you can't take the earnings of one quarter and then divide it by all of the shares. You have to take this quarter that you're looking at and add the earnings of the 3 preceding quarters. So your total earnings calculation takes into account at least 4 quarters, because that's an annualized EPS. When I was writing and researching my own company and valuing my company, that's one of the mistakes I did, is instead of taking the earnings over a period of time, which would be at least 4 quarters, i.e. 1 year, I took the earnings of each quarter and went off of that, and it made my figures very unreliable. Then the PE ratio is actually the price to earnings ratio. That's what it means. So you essentially take the share price of a company, so the price per share, and divide it by the EPS, the earnings per share, right? So you can look at it as, for each unit earnings of a company, so $1, whatever the currency may be, how much do you have to pay for that? Because that's essentially what it's showing you, is you're taking the whole price of the company, dividing by the whole earnings of the company, just in a per share basis. So what does this mean? Well, let's say if the industry average PE ratio is 10 and the company you're looking at has a PE ratio of 15, you may argue that it looks like an expensive company, whereas if it's a 5 PE ratio, you might argue that it's quite cheap. However, this is a very basic kind of valuation metric, and you really need to take into account a lot more, and maybe use a few more metrics to actually find the value of a company, see whether it's over or undervalued, because the P ratio just takes into account the net income as well as the current share price. And maybe the share price as of now is overvalued or undervalued. Obviously that's what you're trying to figure out. And net earnings of a company, or the net income really, well, that doesn't show you the whole truth, because like I said in another video when I was talking about the earnings before interest and earnings before interest, tax, obviously depreciation, amortization, there's a lot more that you can add to the earnings to get a more fair figure for a company and to really compare it to the industry, different companies, etc. So to do that, what we looked at right now is a trailing PE. So obviously the PE based on the kind of statistics and data that we had before, right? It's trailing. But there's also a forward PE, and that's something people use to potentially look at a future valuation of a company. But really the forward PE is, instead of taking the current share price and current earnings of a company, you're kind of trying to see what it might be worth in the future. You're looking at the future earnings. So when you're valuing a company, when you're analyzing an equity, a stock, you're really forecasting the revenues and earnings. So with that, you make another PE, and that's really a forward PE. What people also tend to use is take the kind of average or median PE of a company and just use that as a forward PE. Maybe they believe that it will maintain its current PE ratio for over, let's say a few years, so they don't have to think of a new PE. But yeah, it really depends upon kind of the earnings that you project and then the share price you project because of that. So there's also a lot of different ways of calculating the future share price. I've also made a video on it, so you can go check that out. But yeah, the PE ratio, like I said, it's very basic, very entry level. It's a very entry level statistic to have a look at and see what kind of, where the company is trading at right now in respect to, obviously it's best to compare it to the company itself in respect to where it has been before. So yeah, that's the PE and EPS. It's quite basic. I hope you've learned something from this video, and I definitely recommend you to check out my other videos, because I use these statistics and have a look at other kind of valuation metrics of how you can value a company, which are definitely much better than this. But these are the foundation of equity analysis. Everyone should know it. They're very basic and they're very easy to use, and they can be used in many different fashions. So I hope you've enjoyed this video, and again, I hope you've learned something, and I'll see you next time.